Welcome into episode 60 of Full Throttle, the Presidio Group's automotive industry podcast. I'm your host, Jason Stein, managing director at Presidio.
We've reached an equilibrium or a tipping point, as you call it, that says we go more volume is where pricing and margin starts to break down. And for me, that number's right around 16 million. And if you look historically, we do roughly 1.3 million units a month, not seasonally adjusted. Multiply that out, you're right around 16 million. And when you think about the number of selling days in a month and where inventory level is comfortable around 60 days, that puts inventory right around 3 million units. So for me, 3 million units, 16 million units of sales, right, we're in equilibrium. So to put that in context, the last couple months have been about a 12.8 million units, so a little bit below the 1.3, and inventory has gotten to about 3.3 million. So we're starting to get a little bit out of balance here. And the first thing to go is then pricing and profitability.
Today's conversation is one of those moments where the industry needs to slow down, take a breath, and think clearly about what comes next. My guest is Kevin Tynan, Presidio's Director of Research and one of the most respected analysts in the automotive space. Kevin's 2026 outlook suggests the U.S. auto market is approaching a real tipping point where the last several years of volume growth give way to a far more disciplined conversation about price, profit, and sustainability. For the first time since before the pandemic, we're entering a period that looks organic. No supply chain shock, no stimulus-driven demand surge, no incentive-fueled distortions, just supply, demand, capacity, and some hard decisions. In this conversation, Kevin walks us through why 16 million units may represent a ceiling, not a goal, why excess inventory is the first crack in pricing power, and why chasing volume for volume's sake could quietly undermine both OEMs and dealers heading into 2026. We also dig into what this means across the business, how overcapacity at the manufacturing level could force painful structural choices, why used vehicles are re-entering the equation after years of scarcity, why electrification remains strategically necessary but financially unresolved, and why fixed operations, technology, and operating efficiency may be the real battlegrounds for dealer profitability in the year ahead. Most importantly, Kevin offers a clear warning for dealer principals and executives alike. The next phase of this cycle won't be won on the front end gross. It'll be won through discipline, efficiency, and smart allocation of capital. It's a grounded, candid, highly practical look at where the industry is headed in 2026 and what mistakes to avoid as this year comes into focus. My guest is Kevin Tynan. This is Full Throttle.
Hi, this is Kevin Tynan, and this is Presidio's podcast, Full Throttle.
It's always good when he comes back to the program because it's insights and it's analysis, and we have some fun with the process, whether we're on stage or we're here doing it. Kevin, great to see you again.
Always great to see you, Jason.
Your 2026 outlook, it suggests that the U.S. auto market is approaching a tipping point, if you will, trading volume growth for price and profit discipline. What is fundamentally different about 2026 compared to the last, say, 3 or 4 years?
Yeah, it's organic, right? So I think that 26 looks more like pre-pandemic. You don't have supply chain disruption that we had. I think demand is still there. It's stable. But what you had during the pandemic period that was not normal was that supply disruption. So you had this really tight supply-demand balance. And then coming out of the pandemic period in the more recent years, what you had was operating leverage, right? So everything gets downsized and you rationalize your cost structure, and then you start building volume, right? So you get that sort of flywheel effect of doing more unit sales that are actually accretive to profitability. We've reached an equilibrium or a tipping point, as you call it, that says we go more volume is where pricing and margin starts to break down. And for me, that number's right around 16 million. And if you look historically, we do roughly 1.3 million units a month, not seasonally adjusted. Multiply that out, you're right around 16 million. And when you think about the number of selling days in a month, and where inventory level is comfortable around 60 days, that puts inventory right around 3 million units. So for me, 3 million units, 16 million units of sales, right? We're in equilibrium. So to put that in context, the last couple months have been about a 12.8 million units, so a little bit below the 1.3, and inventory has gotten to about 3.3 million. So we're starting to get a little bit out of balance here. And the first thing to go is then pricing and profitability. You can always do volume. The question is, can you do it profitably, right? There's two ways to grow the industry, to grow that profit pool. You're either going to do more units or you're going to do fewer units at higher price. And so I think we're at the point where we need to think about a 15.5 to 16 million to support pricing where it is. And I think 2026 might be the first year where we see average transaction price above $50,000.
You've been clear that the demand catalysts for this past year, for 2025, tariffs, tax credit pull forwards, incentive driven EV clearance, they're not coming back. They're not going to repeat. Without those triggers, so where does the equilibrium really sit then? Is it that 16 million? Is that why that matters so much?
Right. Yeah. And it is probably below that. I'd love to see a 15.5. I think that's where the industry would be in balance and healthy. And again, you can call the volume number in a vacuum, whatever you want it to be. If the industry wanted to do 17 million, it could be a 17 million unit market. Doesn't mean it's better. In fact, it's the opposite, right? Where 17.5 is actually detrimental to pricing and profitability of the automakers, less so for the franchise dealers. Because there's a benefit to selling a unit, the finance and insurance, you're creating a parts and service customer down the road. There's loyalty, there's recurring revenue streams that the franchise dealers get that the OEMs don't. So there's benefit to volume for volume's sake in terms of the retail base that doesn't exist for the manufacturing base. But I still think that equilibrium, that balance is best around 15.5. And you're right. We had April and March and April that were 17, almost 18 million units seasonally adjusted, because of the threat of the tariff prices going higher and across the board, new and used. And towards the end of the year, by the end of the third quarter, we saw that pull forward from the EVs. Now that's not to say I'm sure something is going to pop up during the year, whether, geopolitically or government wise, that spooks the consumer a little bit, or pulls them off the sideline, if you will, one way or another, good or bad. But as you smooth that out over the next couple of months, because you're always going to have that hangover, and I think that somewhere below 16 million. But again, 3.3 million units of inventory right now, that has to get adjusted too, right? So you either sell that down without increasing production much further to get that balance right around that 60-day mark, or even a little bit tighter would be better.
You compare 2026 to 2019, and that was a year with high volume, but some might not remember weak profitability. What should dealers remember from that period as they plan ahead?
Yeah, that you're basically choking on inventory. So to put that in context, right, we're 3.3, and we're calling that a little bit tenuous, right? 3.3. 2019, it was 4 million. And we're still doing that same 1.3 million units of sales. So you're very, very oversupplied. And you can imagine now you're competing with yourself, with the dealership down the street. It becomes a consumer that's really just buying the deal. It's discounting, it's incentives, and all those things just compress margin for you as a retailer. Now, to build the fleet, the registered fleet, by throwing units into the system over the long term, right? There's parts and service down the road. There's, trade-ins, and, there's a lot of moving parts to the industry, but just, at the base of it, 4 million units of inventory to do 1.3 million units of sales. There's just no pricing power or margin integrity going forward. And I think that's my fear with 2026 is that supply is not constrained unless it is done so by the manufacturer. And we know historically that's not really their response to having the capacity to build more vehicles. They do when they can. And if they do that, that's where you start to see the price and margin and start to break down in 2026. First time we've had to deal with that since 2019.
So, given that, and given the fact that automakers are stuck with overcapacity and suboptimal factory utilization, does that structural reality make margin damaging incentives inevitable? And related, do you see restraint finally winning out?
Yeah, on the restraint side, to me, there's two forms of that restraint. One is, well, let's just not overproduce. The fact of the matter is, you still own that capacity, right? You're still paying those fixed costs. So at some point, and maybe it's not today or tomorrow, that has to be dealt with, right? If we're producing 11 million units domestically and then the other five are imported, we can't have 20 million units of capacity in North America. It's just too much. So you're paying one way or another. You're going to run the factory and you're going to have too much supply, and then you're going to pay the consumer to absorb that supply. You're going to restrict your production, and then you're going to be stuck with a lot of overhead, a lot of fixed costs that you're paying for but not getting any benefit of. Historically, the industry has just continued to produce, figure out how to sell it tomorrow, discounting incentives. At some point, you're going to have to make structural decisions that take capacity out of the system if we understand that 16 million in this mature market, right? Demographics change, a couple more people, right? But that number is not going to shoot up sustainably and profitably. So if we're saying 16 million is a ceiling, we have to watch where our capacity is, and it does have to be adjusted, whether that's consolidation, whether that's closing factories, whether that's finding a new technology to absorb that production. Something has to give at some point, and I feel like we're getting close to that.
Used vehicles begin to re-enter the picture in a meaningful way in 2026 with off-lease supply returning. How does that change the profit equation for dealers after years of scarcity? And does higher supply help revenue but pressure margins?
Yeah, look, and it's the first upswing in off-lease supply, and what we're dealing with what we dealt with in 2025 was the absolute trough, right? That was the bottom because we had, if you think about a 3-year lease term on average. So basically what comes off lease in 2025 is what was leased in 2022. 2022 total new vehicle market was 13.8 million units, right? And you had the consumer paying over MSRP. So essentially what that tells you is there were no incentives necessary. The consumer is paying over sticker. When there's no incentives necessary, leasing is an incentive. It's a form of incentive. So you had very low total unit volume and you had no leasing being done. Normally, pre-pandemic, you would have 30% lease penetration. One in three vehicles sold was leased. Come 2022, that number was halved. It was about 16, 17%. So when you look at the base of 13.8 million units at 16, 17% lease penetration, the off-lease market goes from 5 million every year to 2.5 in 2025. So this is the first year. I think we had about 700,000 off-lease vehicles to about a 3.1 million. So well below historically what we're used to, but better than 2.4 million. And we've seen what's happened to used vehicle prices. Same thing as new vehicle prices, right? As one thing inflates, so does the other. So a little bit of relief, but certainly nowhere near the flow that we saw prior to 2020.
Kevin, you've been blunt that EVs have been a profitability challenge across the value chain. With subsidies now having faded, How do OEMs rethink electrification without walking away from it? And in some cases, if we look at recent headlines, they are almost completely walking away from it with massive write-downs.
That's something else. Boy, I feel a little vindicated, justified, because I've been talking about this for years, right?
Yeah.
And I don't know if it's an I told you so, but look, to me, at the end of the day, the industry, every business is about profitability, about making money. We're not making cars, we're making money. And that's one way that we do it. So for me, the profit dynamics of that technology either had to improve significantly or it's just not sustainable. And we saw the announcement from Ford, huge write down. I think there's going to be a lot more of that coming. And, that's kitchen sink, throw it in the fourth quarter, be done with it, not cash charges, so that those are what they are. But I think what's interesting to me is, okay, now what, right? Well, on the one hand, it's like, to me, that was the technology that was pushed to the forefront to say, here's how we're going to get customers to pay more for basically the same transportation. That's how the industry grows. The revenue pool, the profit pool grows. Again, one of two ways: more volume, lower prices, or less volume, higher prices. This was the latter. This was to say to the consumer, we've shifted our mix to trucks. Our jump off point is now EVs. Here's how we convince you to pay more because there's new technology, fewer moving parts, more reliability, convenience. Don't have to go to the gas station. Now, when that fails, to me, the question is, okay, now what? Right? Not can we sell trucks? Sure, we can sell trucks, but how do we sell enough trucks to continue the revenue pool and the profit pool to grow? And to me, that's the scariest thing about the walk back on EV is that it's a now what question. We're 84% truck in the US. It has to go higher, right? Because that's how the revenue pool is going to grow because we can't shift the mix to EV now. It's not happening. So I think what you're going to get from OEMs is you're either going to get a real walk back, and I think that happens. And if you look at Ford as the example, the higher price, the higher transaction price things, you think about GMC, Hummer, and six-figure EVs, Ford F-150 Lightning, 70, $80,000. To me, that's where it doesn't work. I think what you could get is to absorb some of that capacity, that production capacity, with affordable. And again, I always joke, even with you say affordable, I say unprofitable, same thing. But what you can do is you can create some affordable product there, in the EV space. You're going to lose money there, but maybe it's an introduction to your brand. Maybe it's a way to build a younger customer base and then move them up through your product portfolio if you're going to do anything with it. I think the idea of six-figure EVs those are just going to sit and they're going to start to stink on the lot. And I don't think it's the way forward, right? I think what you have to do is to say average transaction price is getting to $50,000. Here's a $30,000, $35,000, $40,000 entry vehicle. It's good. It's technology. It's an introduction to our brand, and you just control your output so that you don't lose too much money, right? Because the risk you run is that it becomes wildly popular in the way that people are buying your cheapest thing, which you really don't want, right? You want an introduction to your brand and build a customer base, but you don't want that to be the thing that you are known for and the only thing that you can sell is your affordable, unprofitable things, because it defeats the purpose of being in business, which is to actually be profitable and sustain the business going forward.
Fixed operations continue to be the industry's profit engine, helped by an aging fleet, record miles driven. What constraints could limit how much dealers can actually capture? And is technician availability the biggest bottleneck?
Yeah, that's huge. And again, to me, that's, I look at it and to your point, right? The fleet is the largest ever in the US. It's the oldest ever.
Oldest ever.
Miles traveled is back above pre-pandemic levels. So we're out there, we're shopping, we're commuting, we're moving around again, which tells me, man, there should be an addressable market of repair and maintenance that is growing, right? And it's huge. You know, you start to see things that repair order numbers are down or hours are down, and I'm trying to put that together. It doesn't make sense. So yeah, the technician constraint thing is one of it. But I also wonder, Jason, like, is this a little bit of what happened in the new vehicle market, which is to say, I'm a dealership with a finite number of service bays, a finite number of technicians, and I want the most profitable work. Give me the high revenue contribution, the high profit contribution work, because it doesn't make sense for me to tie up this expensive bay and this expensive technician for a 1999 oil change, right? So I wonder, you know, and to it may be a little hyperbolic, but I'm saying that the franchise base is actually turning away from some of that business. Now, I understand, get somebody in the bay, get the wheels off, get it up in the air, right, and you can upsell, and I think that's where the opportunity is. I will say this, I think fixed ops, as we talk about the pivot, because the new vehicle market gets tough going forward above 16 million or 3 million units in inventory, we're still working out, you know, supply on the used side. Fixed ops to me is the opportunity, but it's going to take some creativity, you know, some expertise in actually finding a way to grow the revenue pool profitably, given some of those capacity constraints on it, right? And again, I just don't think that the franchise base is so concerned with losing quick oil change business to, you know, a Jiffy Lube kind of place, right? It's not, you can't live there sustainably and profitably. So I think there's a lot of software and technology and tools that can help dealerships be efficient in that business and their other business units. And I think that there's going to be a little bit of studying and researching being done to figure out how to wring out 50, 100, 400 basis points of margin in those other business units in 2026.
So, related to that, you have highlighted technology, automation, AI, digital tools as the next lever for margin expansion. Where do you see the clearest ROI for dealers in 26?
Yeah, I think it's going to be there in fixed ops. F&I is another one too, right? And I think, again, when you think about a revenue pool and not just volume, right? So we're saying volume will probably be down, but transaction price in new and used is probably going to be a little bit higher. And I think that's where the opportunity or the revenue pool growth comes from. So I think finance and insurance is going to be a big part of that. You may not have as many transactions, but they're going to be more valuable. Little bit scary, and this is, you know, maybe a little bit inside baseball or nuanced, which is to say, you know, we're coming out of this, or we're entering this period, which is, if you think about 4 years as the average term for a new vehicle buyer, that they hold on to it before they start looking into some other things. What was sold 4 years ago, as we get into 26, 4, 5 years ago, was the most expensive stuff. That was the stuff over MSRP. So when you start to think about equity in those trade-ins, it's probably not great and not getting better immediately in 2026. It probably gets a little bit worse before it gets better. So when you think about how deals get done, the value of the trade, the price of the new one, I think it's all inflationary, and the problem you run into is that negative equity, right? Where are we on that? And you see some delinquency numbers, and you know, it's not I don't think it's a today or tomorrow problem, but it can be a big deal. The other thing I think also is that when the last time that was a big deal, global financial crisis, 2008, 2009, we had way bigger problems than simply auto loans, right? Everything fell apart, you know, financial markets, mortgage. So you're not going to miss it if it gets that bad again. But under the surface there's some churning that's a little bit concerning about negative equity. And if the credit markets freeze up a little bit and you can't roll that equity into a new vehicle, you start to see some pressure on that system. Again, volume being a little bit lower because of it, to me, not the worst thing if it firms up pricing and margin. But there's certainly something to watch there on the F&I side. It's an opportunity, but there's some warning signs I'm seeing there as well.
So final thing, Kevin, if you were advising a dealer principal heading into 26, what's the single biggest strategic mistake they should avoid?
Volume for volume's sake, in my mind, right now. So I think what you need to be, the way that an OEM needs to be disciplined with production, I think that a dealership needs to be disciplined with purchasing, right? And that, this is not 0% interest days where there's no carrying costs. And I'm speaking in the extreme, no carrying cost to having excess inventory on the ground, right? It's not those days anymore. And I feel like that there's certainly, when interest rates are not zero, it's a little bit easier for the dealership to push back and say, I can't take your overproduction because it's not free for me to do it anymore. Now, we know in this business, there's a lot of you scratch my back, I scratch yours, and there's other ways that deals get done and grease for the system. But that would be it. I would say that I think you want to be disciplined on your new vehicle inventory and really start to explore efficiencies in your operating expenses, in fixed ops, in used, and even in F&I. I don't think you can look to your gross profit line and expect 2021, 2022 to happen again, where the consumer's paying over MSRP. Your gross margin, I buy it for a little bit, I sell it later today for more or over sticker, right? Those days are gone. I think where you're going to expand your profitability as a dealership is in your operating lines. And there's plenty of tools, and we hear the AI buzzword constantly, but there's tools out there that will help you wring out those extra basis points, because I think it's going to be 10, 50 basis point moves in your operating expense lines, as opposed to 500 basis points in your new vehicle front end gross or your used vehicle front end gross, right? You might get a little bit there. I think that becomes more and more difficult. You're gonna have 10 little moves in your operating lines than one big move in your gross lines.
Wonderful. Always great to be with you, Kevin. Thanks for setting up the year ahead. And we will check in multiple times this year.
Happy New Year to you, Jason.
Same to you. Thank you. That's the 60th episode of Full Throttle, and special thanks to my guest, Kevin Tynan. Thank you for listening. For a library of these episodes with industry leaders, go to thepresidiogroup.com. You can also find a library of these shows on the Presidio Group's YouTube channel. I'm your host, Jason Stein. We'll talk to you again next time.